Alright, listen, everyone is talking about how Dubai real estate is booming. Your friend who just flipped a studio in JVC, the influencers on TikTok and YouTube. Everyone is making it sound like buying a property here is the easiest way to get rich. But no one is telling you what's really going on. Developers are launching projects like it's a race, over dozens of thousands of new units every year for the past 4 years, and it's not slowing down. On the surface, it looks like opportunity, but underneath, it's starting to crack. And if you don't know where to look, how to buy smart, or what is quietly killing returns for investors, you could end up stuck with a property that no one wants to rent, or even worse, that no one wants to buy when you want to resell. In this video, I'm pulling back the curtains. I'll show you exactly what most agents and developers will never admit. How to spot the traps before they cost you. If you are even thinking about investing in Dubai real estate right now, you need to see this. Dubai is on fire right now. Prices are climbing, everyone's launching new projects. Agents, influencers are pumping out real estate content like it's crypto in 2021. But under the hype, there is a serious problem that no one is talking about, and it's already burning some investors. In this video, I'm going to break down exactly what's happening behind the scenes, from oversupply issues that could crash prices to developer tactic that leaves buyers stuck, to the real reasons rents in some areas are already dropping. I will show you what to avoid, how to spot red flags, and how smart investors are still making money while everyone else is walking straight into a trap. Whether you are thinking about buying, or you already bought, or you're just watching the market, by the end of this video, you will see Dubai properties through a completely different lens. Let's zoom out for a second and talk about why this is happening. Because this isn't random. Since 2021, Dubai has seen a huge surge in demand. You had remote workers moving in, crypto guys buying penthouses, European investors looking for a tax-free haven, and everyone else just chasing the returns. Developers saw that and thought, okay, time to build. And they didn't just build, they launched projects like crazy. We're talking about thousands and thousands and thousands of units built every single year. They almost built an entire new city in the past few years. Why? Because launching new projects is good for business. Developers collect off-plan deposit, it boosts their cash flow, and they ride the hype. And honestly, Dubai's government is encouraging it. It brings in foreign investment, it boosts the GDP, and it keeps the city expanding. So overall, it is a good thing for the development of the city. But here's where it starts to get dangerous for investors. A lot of people are buying properties today based on prices and demand and excitement from today. But those properties, they won't hit the market until 2026 or 2027 or even later. And between now and then, the entire market landscape can shift. So what looks like a hot deal right now could end up being just one of the thousands of units that will be flooding the market in a few years, in a time when the demand might not match the supply at all. So that is the setup. It looks like growth, but in reality you could be buying into a mirage. Alright, now let's break down what it really means, and we are going to keep it simple. The number one thing you need to understand as an investor in Dubai right now is the oversupply. So what is it? It's when there are more properties available than there are buyers or tenants ready to take them. And when that happens, the power shifts. Prices start dropping, rents get more competitive, and suddenly it is not a seller's market anymore, it is a buyer's market. Now let me make this super visual for you, because this is where most people go wrong. Imagine that you are at the beach on a scorching hot day. You've got a little cart with 10 ice cream left. There is a massive crowd, sweaty, thirsty, everyone wants one. That's low supply. You can sell those ice cream fast, probably even increase your price and still sell out everything. That is what Dubai felt like post-COVID. Tons of people moving in, not enough inventory, prices shot up, rent exploded, and everybody felt like a genius investor. Now let's flip the script. It's a cold, rainy weekday. You've got a whole truck full of ice cream, but the beach is empty. That's high supply and low demand. Now what? You're lowering your prices, offering discounts, and maybe you're even giving away freebies just to offload the stock. Same thing happens in real estate. When too many properties hit the market and there are not enough people to buy or rent them, owners start competing. They lower prices, they offer incentives, they reduce rent just to avoid vacancy. And this is what is brewing in Dubai right now. Developers are launching by the thousands, entire communities are being built at the same time, and if the demand doesn't keep up, that's how investors get stuck. So you will see the prices starting to go flat, or even worse, they could slide down. And when rents drop, your ROI starts shrinking fast. A lot of people don't see this coming, and a lot of people don't want to believe that this is what's going to come. Because when you buy a property, you need to be thinking 2, 3, 4, 5 years ahead because you are going to resell that property. But most people today are just thinking this tower looks great, the payment plan looks nice, I will resell 30% higher in 2 years. But the question is, how many other people are doing the exact same thing in the exact same area at the exact same time? That's oversupply. It's already happening in pockets of Dubai. You just have to know where to look. And here is where it gets even trickier. And this is something that 99% of new investors completely overlook. It is what we call the lag time trap. When a developer announces a new project today, that property isn't going to be ready next month. It's going to be ready in 2, 3, 4 years from now. And that's where there's some issue for me today, because while you're buying based on the excitement of today, that unit is going to land in a totally different market environment 3 years from now. Let me give you a simple example. Imagine in 2023, you bought an off-plan apartment in a new luxury tower in JVC because prices were hot and units were selling out fast. But guess what? That same year, 10 other towers launched in JVC too. They all look great. Same promises, same delivery date. Fast forward to 2026, suddenly thousands of brand new units flood the market at the exact same time. But the demand, it has not grown as fast. So what happens next? Prices don't climb like you expected. They level out, maybe they even dip. Renters now have more options, so the landlord, they start cutting rents and offering free months. And your great investment, it's competing with everyone else who bought during the same launch time. That's the danger of the lag time. So it's not just what you are buying, it's when it enters the market and what that environment looks like when it does. And when you buy, once you have committed, you're locked in. You can't just undo the contract or fast forward the market. This is why buying off-plan during a boom without understanding the delivery timeline and the competitive landscape can break your returns before you even get the keys of your place. Now let's take this one step further, because the lag time isn't the only problem. The real danger comes when you realize you're not the only one investing in that area. You're not even one of a few. Right now in Dubai, dozens of developers are launching projects in the exact same neighborhood with identical timeline. And they are all using the same strategy. Launch now, deliver in 3 years, promise luxury, sometimes you undercut the price, sometimes not. So what does that mean for you as an investor? Simple. When the handover finally happens, you're not just listing your units against a few resales, you're competing against hundreds of thousands of nearly identical units, all in the same area, all priced similarly, all brand new, and all from different sellers who need to rent or sell just like you. It becomes a race to the bottom. Whoever is willing to drop the rent lower gets the tenant. Whoever offers a better price gets the buyer. And it's not always about quality, it's about timing and volume. Imagine 15 towers with hundreds of units completing in the same area within 6 months of each other. That's thousands of units hitting the market in one community all at once. Even if each one has good finishes, smart layouts, supply overwhelms the demand. Prices flatten, discounts become the standard, and if you need to exit, good luck. The winner in this situation is the developer. They have already collected most of the money and they are going to find a way to collect the rest from you. But you are now one of hundreds trying to rent or flip a product that is no longer exclusive. Now that's a saturation effect. It's death by 1,000 listings. And most people will not realize that they are walking into this trap until it's too late. So now let's say that you went ahead and bought that shiny off-plan unit anyway. You've waited 3 years, the project is down, you get the keys. Now you are excited to start earning some passive income, right? But here's what will happen. You list your unit and so do 300 other owners at the same building. So suddenly the tenants have options, like a lot of options. Every other unit has the same view, the same layout, maybe even a slightly better furnishing or a better kitchen. So how do you get attention? You drop your rent maybe 5 or 10% lower than the market. Maybe even offer 3 months. And just like that, your expected ROI starts shrinking. If you are banking on the 8% rental yield, you're now pulling maybe a 5.5% after the service charges, the vacant months and agent fees. That changes the whole deal. And it's not just the rent. When there is too much supply, the capital growth slows down too. You cannot sell at a profit because no one wants to pay more when they can get something next door for the same price or less. You get stuck holding a flat performing asset that looks great on paper, but in real terms is just sitting. And here we are not even talking about a market crash, we are just talking about a slow bleeding territory. the kind where you're not losing all your money, but you're not growing it either. And in real estate investing, time is supposed to be your ally. But in an oversupply market, the time works against you. Alright, let's flip the script again, because here's the truth. Oversupply is not all bad news. It's actually an incredible filter. It separates the emotional buyers and the strategic investors. See, while most people panic when they hear too many units, the smart investors, they start looking closer. Because oversupply doesn't hit every area the same way. Some neighborhoods are drowning in launches, while others are already built up with very little land left to develop. They are the mature zones, like Dubai Marina or GLT. In these areas, the supply is fixed or extremely limited. No one is going to build 10 new towers next to each other next year. Even though an oversupply issues in Dubai will affect the whole market, some of these areas will experience a less strong effect. The rental demand can stay strong in some areas, or the prices can hold, or it can even grow. Because in these areas, there will still be some level of scarcity, and in real estate, scarcity is value. So in this area, you will be less gambling. No crazy high appreciation because the neighborhood will not develop incredibly in the next 5 years. But at the same time, they might provide you a far more stable long-term return. Now, if your budget does not allow you to buy into those premium areas, don't worry, there's still opportunities. That brings us to the strategy number 2 that we call the micro-location advantage. Even in saturated areas like JVC or Business Bay, not all properties are created equal. Some buildings are in high traffic zones, near schools, near metro stations, or next to huge parks, or next to a mall. And others, they are surrounded by constructions or buried deep where no one wants to live. For example, the property I bought in JVC is located 2-minute walking distance from a primary school, and it's also very close to the exit of JVC. So my belief is that when the JVC area will be impacted by the oversupply, my building is going to be a bit less impacted. So that's the kind of security that I bought for myself, even though, to be honest, I'm planning to exit before the oversupply hits. So no, not all buildings, not all units are the same. In the same area, in the same launch cycle, you can get completely different outcome. The key is this: don't just buy the area, buy a specific opportunity, the developer, the micro location, and the value it offers when everyone else is competing. In a market full of noise, the winners will be the ones who choose with precision. So here is the reality. The Dubai real estate market is still one of the best markets in the world, but only if you play it smart. The oversupply, the lag time, the developers saturating the market, they are not reasons to avoid investing, they are reasons to invest strategically. That means picking up the right location, the right building, the right developer, and understanding the timing of your exit. Don't follow the hype, don't chase launches because they are trending. Look deeper and think longer. And if you do it right, you are not just avoiding the risk, you are setting up yourself to win while everyone else is playing the short game. If this video helped you and you want more straight up, no fluff insights on Dubai real estate from an investor perspective, go ahead and hit that subscribe button. I break down this market multiple times a week so that you can make decisions based on logic and not hype. Don't let your next move in Dubai be based on noise, base it on numbers. Thank you for watching, and I will see you in the next video.